welcome to Market Matters presented by MyX. I'm Joe Teague of Equity Armor Investments, and today we're going to be talking about some of the key sentiment that's out there in the market, some of the things that are moving the market. I like to look at all the options volatility. I like to look at key events that are happening, and this week we have Brian Stutland, my partner at Equity Armor Investments, joining us, and we're going to be diving into all of that and more. Hello and welcome traders, welcome vol traders. I'm Joe Teague. With me is Brian Stutland. We have a flat market today, not a lot going on as the market's just digesting that huge move we saw last week. We had a big rally and interest rates fell off a cliff, and not surprisingly, volatility came with it. Brian Stutland is my partner. We're both former options market makers. Brian was a key trader in the VIX bit in the very early days. How are you doing today, Brian?
Great, Joe. Thanks for having me on here.
Yeah, it's exciting. This is our first show. I'm really excited about it. So hopefully we can share a lot with you, our former experiences, what we're seeing out there in the market. Just talking backstage, it doesn't make sense for me to make any predictions about what exactly is going to happen. That's not what anybody can realistically do, but it does make sense to look at what is going on and think about times that's happened in the past and see if we can get any clues about where things are leading us. And with that, let's just take a look at current last week's action and what we could have known beforehand. And if you're following along weekly, I think this is the type of thing that you're gonna be able to do with us. So let's just take a look at our slides here from last week. And heading into the week, things were pretty bearish. In fact, we had pretty close to a 52-week high in bearish sentiment. So everybody was piling on this bearish sentiment. Now, of course, this is going to be the most bearish right when things turn around. So it's a very big contrarian indicator. That's one of the things as a volatility trader I like to look at. But if you look at like the weeks before, we had really negative weeks. The market was collapsing, yet the bearish sentiment didn't really peak until it did actually hit the bottom. And it's interesting to see the 52-week high right at the end of last year, right at the low spot in the market last year. So really fascinating to see how this bearish sentiment kind of works out. And it's really at its worst right when the market is close to a bottom. And for me, this is similar to like that elevator indicator, the taxi cab driver indicator. When everybody is on one side of the market, it's usually about to go the opposite direction. So,
and
right, if you're an instance like that.
Yeah, and Joe, what I think was really most interesting about last week and the reversal and the market move up that we had was when you looked at the volatility indices out there and something like the spikes, which tracks the implied volatility on SPY, the Spider ETF. When you look at something like that, we saw the market at the end of October continue to sell off, and yet the spikes was not really getting up into these fear indication areas of, let's say, above 30, and instead was actually holding at lower highs as the market continued to fall on, let's say, its last 100-point sell-off. To me, that was an indication that option traders in SPY were actually selling puts, or people in the S&P 500 were selling puts, expecting that some sort of level of bottoming. So as sort of this bearish indicator started rising, the real institutional paper out there was saying, hey, maybe this sort of 4,100 area in the S&P was an area to sort of get long the market. 4,000 was an area to get long the market and look for sort of this reversal. So option traders got this right, as the rest of the public, like Joe, you mentioned, the taxi cab driver was getting very fearful. And then they basically got their heads ripped off as the market then moved 4 or 5% back to the upside.
Yeah, that's absolutely right. Actually, look at the spike index. It was hovering above 20 for about a week and a half as the market was drifting lower. Yes, it never got that major spike. We never saw anything above 25, certainly. Nothing close to where, real fear, when we think of fear, is like the 35 to 40 range. No, nowhere near that. And yeah, that turnaround was dramatic last week. Just 5 straight huge negative days to close the week under 16 is pretty dramatic for me when it comes to a volatility suppression.
Yeah, absolutely. And I think a lot of this came actually when we saw the 10-year note sort of get above the 5% level. We had people like Bill Ackman. We saw Gross, formerly at PIMCO, basically come out and say, hey, we're no longer going to have our short position on the long end of the treasuries. We saw the 10-year note rally. In other words, interest rates fall about 50 basis points, which was huge. That was significant. It went from 5.15 down to 4.65 where we see it today. And that really triggered the rally is maybe traders after the Fed spoke really said to themselves, well, maybe on the long end of the curve, this is sort of the end. And maybe we are starting to get some recessionary type indicators coming on where it's going to be anti-inflation and prevent sort of the Federal Reserve to continue their march with significant rate hikes, meaning that the long end of the curve maybe has seen its like top level sort of on the year.
Absolutely. Yeah, that was a big move on the treasuries. No question about it. Yields were hammered. Yields were crushed. The Fed maybe mentioned the conditions have tightened, and that was enough for the market to just tank these yields. It's fascinating to me just looking at the treasury futures. Like, this is the first time in a long time we've had a higher high on these futures. So that for me is pretty significant. We've had rallies, we've had sell-off in yields before, we've had rallies in treasuries before, but to get this higher high is very significant. And we actually did even close above that area in the 2-year, which was even more significant. So the 2-year was really big, really strong sell-off in the yields, and a meaningful change in just kind of the dynamic of the market, because this market's been fixated on yields for the better part of 2 years, and to get this change of, oh, hey, we got a lower low here on the relative basis on these yields, a higher high on these futures, that is a different. And for me, I think that might shift the market to an instance of wanting to buy any dips. If the bulls are really going to be in control, I expect that to be what's going to be taking forward in the next month or so for the rest of the year. Any dips will be met by buying by the bulls. Yeah. So, and some of the big components to this, of course, the dollar took a huge hit last week. Not surprising when you see these yields falling. The demand for treasuries shifts. People don't want dollars as much, and yeah, the dollar a very meaningful move down. This is something we've not really seen for some time. A big drop in the dollar. This is a big paradigm shift too. I think we have to be aware of that as we're trading, and it's actually just a tailwind to equities and anything priced in dollars. It does help. Things just cost more abroad when the dollar's falling. So anything priced in dollars gets a little bit of a boost when the dollar falls.
Yeah, what I thought was interesting is even prior to this is when the dollar started kind of going sideways. We saw gold prices really, hit that $2,000 level, and they haven't really continued to extend that rally. We haven't even seen, we saw Bitcoin spike on, some of the geopolitical risk that was occurring in the Middle East, but since then, all those have sort of leveled off. And even though we've gotten a weakening dollar, which you think that money would then flow into, whether it's cryptocurrency or gold on a weakening U.S. currency market, we didn't really see that. In fact, the money flow actually seems like it went into equities instead. And so people were really looking for value, and, especially value, Joe. I mean, we've been talking about it recently, amongst ourselves, is, the Russell 2000 being one where PE levels are at a very attractive levels. We sort of saw this type of shift into the smaller cap aspect. It'll be interesting to see if that continues, or the sort of quote unquote, Microsoft and FANGs of the world continue to lead this market.
Yeah, it was just part of the bearish sentiment leading up into last week. People just short, U.S. economy. That led to the Russell being very weak. I got a couple of charts of a couple of really interest rate and economy sensitive charts. I think were just fascinating last week, just the straight up rally that we saw. So here is the regional banks, and that was just a massive ripper, interest rates coming down are huge for them. The fact that the jobs number wasn't just atrocious was huge for regional banks. So, that was maybe something where we saw some shorts offside, head to chase. But really, this is a fascinating gap up here in regional banks.
Yeah, it is. And I mean, obviously, like the lower end and people just being, worried about the higher end of the curve affecting the balance sheet of some of these regional banks. Obviously, as you remember back in March or whatever, we had a lot of issues with regional banks and interest rates moving higher. So people feel pretty good. But if you look at a chart even further back, I would even say, Joe, the regional bank area has been a very difficult area to be an investor in, or financials for that matter. There's really been a concentrated few names in there that have really led the charge, and be able to sort of grind and make money and go higher here. And so that comes to some of the big money centers, names like Berkshire Hathaway, which actually falls under financials, have done exceptionally well. Some of these other regionals have really been stuck in the mud as interest rates have tried to, sort itself out. So, the expectations is this a meaningful start of a bull rally? We'll learn soon here, but certainly it felt pretty good to see the long end of the curve come down in yield here and maybe, shore up some of the balance sheets.
Yeah. And, today, the major indexes are treading water. IWM, the Russell 2000, they're getting hit today, down 1.5%. Regional banks also down. So yeah, there's some consolidation maybe, as I mentioned, for the bulls. This is going to be the time for them to step up, buy the dip, if they really do have control. And yeah, speaking of another name, same exact story, hit today, down 1.5%, but had a tremendous recovery last week, was the home builders. Very interest rate sensitive, obviously, very economically sensitive. They bucked the trend this year. Everyone expected, because of the higher mortgage rates, nobody is going to be wanting to be buying houses. Well, maybe that's true. There are fewer houses on the market, but that's really been beneficial for the home builders. Nobody wants to sell their house, but new people are still looking to buy a house. So the market is basically only new houses. So it's been fine for the home builders. They've been able to weather the storm on these super high mortgage rates. People are saying, how long can that last? And it's my prediction, or my assumption. Historically, this has played out that when the economy does slow down, you're going to see it kind of first here in the home builders. You're going to see a slowdown here right before. It's kind of like a leading indicator, if you will, in the economy. And that the economy being as strong as it is not really showing up yet here in the home builders. A nice recovery off of those lows for sure. And again, another area where people probably were expecting higher for longer, expecting interest rates to stay up above 5% in the 2-year, and it did not, and were caught off sides and had to chase into last week. Same story, down 1.5% today. We'll see how it plays out the rest of the week.
Yeah, I think it's pretty usual to see some sort of pullback and consolidation to see if it holds. But again, it's been a tough go for both regionals and the home builders recently. So could this just be a bear market rally? We'll get to see. I'd be watching for typically a 61% retracement off from low to high. If it breaks that, it's usually an indicator that we're going a lot lower. So you get a 2/3 retracement, and that usually triggers some selling once you get to that point. And so that's something to watch on a couple of these levels here and seeing if they can hold their bounces.
Yeah, it's just been a tremendous recovery. Nice consolidation today. Some of the biggest winners last week, as I mentioned, are pulling back today. So we'll have to wait and see. For me this week, I'm really necessarily looking to a ton of news. Next week, we're going to get some big news. We're going to get some of the inflation data in the middle of the month. So I think the market's really kind of setting up for that. The CPI, the PPI, the past year and a half, that has been a market mover. And the Fed being data dependent, I expect that to continue.
Yeah, it certainly will be most likely a volatile session over the next week. Obviously today market's taking a breather, but if I was an option trader, I'd be expecting some volatility heading and positioning myself ahead of that and see how that could play out. Obviously, we saw the spikes index back off significantly here, sitting now in the mid-teens, which historically is below its historical average. So to me, it says, so sentiment now in the option trading world says, well, maybe we get some consolidation here, but we'll see what happens. Obviously, the data coming up is going to, provide some level of volatility going forward. So we'll see how that shakes out. And, I'm starting to position ahead of that economic news.
Yeah, the spike index right now, 16, kind of close to where a historical average might be. I think maybe a little bit lower would be the kind of flip contrarian. Like we mentioned last week, the contrarian indicator of the bearish sentiment was close to a 52-week high. And that led to the bottom of our short-term bottom, potentially of equities. You could make the case if the spike index were to drop 14 or so, you might say, hey, this is an area where historically this leads to a shift. I think it's going to take some time. I think it's going to take some consolidation. We'll have to wait and see. For me, again, we're going to have to wait to see more data on the Fed or something to change, because right now we're kind of stuck here today, at least. And it's interesting. Also, last week we had the big winners in the small caps. We had big winners in the regional banks and the home builders. The outperforming today, kind of another shift, as we got the mega caps leading the way today.
Yeah. So, I would say, just to sort of, wrap things up here, is we've had an interesting week. We saw the Treasury market, obviously a rally big there on the end of the curve. Double line and Gundalaf basically saying that, now is the time to buy corporate rated, investment grade rated bonds. And so maybe this is the beginning of sort of the top in the interest rate levels. We're going to be checking in and obviously providing you some updates in our next show as we get these huge economic data and the PPI and CPI coming up next week. We look forward to giving updates on there. And Joe, any last thoughts here?
Yeah. So bottom line is we have to just continue to watch the market. Historically, I've been in the financial world since as a trader since 2005. Brian a bit longer, a little bit longer than me. Since my time, we've seen a lot of things that are really troubling. A lot of times where it feels like, oh man, the world is about to end. How can we possibly recover from this? And every single time we do. So I think the history of trading is just the market climbs a wall of worry, and this is not unusual. It always does. Now, there are certain times that are riskier than others. There are certain times that are more attractive than others, and it's just as a trader's point of view, is just find those times and trying to act accordingly. Use the data, use the historical averages, and allow us to maintain that long position or maintain our equity position just with a less risk. So I'd like to thank everybody for joining us. This is Market Matters presented by MyX. I'm Joe Teague of Equity Armor Investments. This is Brian Stutland of Equity Armor Investments. Very, very fun having you here today. Very fun talking about the market, and I look forward to doing this every week.